Hi, this is Matthew Cratter from Trader University, and today I want to give you an update on the ongoing stock market crash and tell you where I think the market is heading next. If you're worried about a bear market or just want to see what I'm trading in these volatile times, be sure to hit that subscribe button. So let's recap very briefly where we've been. On February 17th, I released a video on YouTube warning about an imminent stock market crash. Now, this was driven by my concerns about the yield curve inverting in August, late summer of last year. We got the 2s and 10s inverting briefly, and this has always been a harbinger of potential bear markets. And it looks like that the coronavirus may be tipping us into recession and a bear market. And so this video was released on February 17th, which was right here, warning about a stock market crash. We did get the stock market crash. And then on Friday, right before I went out of town, I warned that we were very due for a reaction bounce, sort of a dead cat bounce. That video was published right here. So we've had this very strong bounce, and as is typical in these things, you tend to get a roughly 50% retracement. Has been my experience. So if you measure the highs of the S&P 500 down to the lows, and you take the middle of that, you end up at about 312. This is sort of the middle of the range, and what will often happen is you will have an initial sell-off, a bounce up to somewhere of halfway of that sell-off, sort of a 50% retracement, and then another move down. Now, what has driven this retracement? Well, it's been a number of things. There's been, as I warned about in my video last Friday, about a huge stock market rally coming. The Fed cutting rates. They did an emergency rate cut on Monday, and we got the biggest bounce that we've really had in the stock market since 2009. Now, what will often happen is people will think because you get a strong stock market rally that you're back in a bull market. But my experience has been that the strongest rallies, the really strong snapback rallies, happen in bear markets rather than bull markets. And that makes me think that we're sort of on the cusp of a regime change here, and that this is not going to be the kind of V-shaped recovery that we've been seeing in the past. In spite of the Fed cutting rates, and in spite of Joe Biden almost certainly winning the Democratic presidential nomination after the elections yesterday on Super Tuesday, I think the market was worried about Bernie Sanders or Elizabeth Warren as being wanting to raise taxes and probably being bearish for the stock market. So we're getting this kind of combination of Fed cutting rates and sort of a relief rally, because Joe Biden is really of the mold of kind of a center figure like Obama, who was also very good for the stock market. And so we have this relief rally against a backdrop of the coronavirus proving a little bit more deadly than the initial estimates. So the WHO, the World Health Organization, just came out yesterday, and said that so far the tracking of this virus, 3.4% of people who catch it have died. The initial estimates were something like 2.5%. So it looks like it's more deadly than we thought before. It seems to predominantly affect people in their 50s, 60s, 70s, 80s. That's where the high death rates are, in people with pre-existing conditions, chronic health conditions like asthma, diabetes, heart disease, etc. So this is still a very, very serious virus. And I'm going to put a link in the description notes below to a very interesting map that's put out by Johns Hopkins, where you can sort of track the number of confirmed cases, the number of confirmed deaths, and also, optimistically, the number of people who have recovered. Over here, we've got the people, the total recovered. But I think the real problem with this virus is you have two choices. You can either quarantine people and try to stop the spread of the virus. You can block airline flights from certain countries. You can make people work from home. You can encourage people not to travel and get on airplanes. But this is highly recessionary, and this is one reason that we've seen the Treasury yields fall so much. So, for example, the trade we've had on has been IEF essentially, which is the Treasury notes, and this is an ETF IEF that basically goes up when interest rates go down. And you can see that the 10-year note has basically been pricing in a recession. TNX is the ticker here. You can see yields have fallen below 1% on the 10-year note, the U.S. Treasury 10-year note, for the first time in history. This is much lower interest rates than we even hit during the Great Financial Crisis. And what this indicates is that the market is pricing in a recession. At least interest rates are pricing in a recession. I'm not sure we're seeing that yet in the stock market, which is another reason I'm expecting another leg down. You can see we've been playing around here, chopping around the 200-day moving average. So we've had this nice retracement back to the 312 level, briefly intraday yesterday, and then a sell-off into the Fed cutting rates. And today is a little bit undecided. It's been testing the 200-day moving average, currently trading above the 200-day moving average. I'm expecting another leg down. So this is definitely a hostile environment for momentum stocks. It's a hostile environment for basically anyone who's not a highly experienced trader. So if you did not trade during the 2008-2009 Great Financial Crisis, and you've only been trading in the last 11 years of a bull market, I would highly suggest that you stay out of this. Don't try to trade. It's extremely volatile, and you can get whipsawed going long or going short. If you have a long-term perspective, 5, 10, 20, 30 years, it's possibly a good time to be nibbling on your favorite stocks, maybe buying index funds, as long as you don't mind a drawdown, because I think there is another leg down coming. I think we're very, very far away from a resolution to this. Maybe we get lucky. Maybe I know the Israelis said they were working on a vaccine or treatment for this. Maybe we get lucky and there's a sudden treatment. But I think there's been enough economic damage that's happened already in terms of lots of layoffs of airplane employees and longshoremen and the people who really make the economy work, as well as sort of permanent damage to the idea of outsourcing manufacturing to Asia and having it really concentrated in places like China. So, for example, now if you're making a $60,000 car and you need this $5 part from a Chinese factory, and that factory is closed because of coronavirus, you cannot build that car, you cannot sell that car. People are staying at home, watching Netflix, canceling their summer European vacation, and there's quite a bit of fear, rightfully so, especially if you are older, have chronic health conditions. I've been sort of leading my life as normal. I got on an airplane over the weekend and went to California and basically was probably exposed to everything. I'm still under 50, so the mortality rate is lower. But I think this is something to be very, very cognizant of. Certainly not to panic if you've got a long-term time horizon, because the U.S. will deal with this. But in the meantime, we may have a 6 to 18 month bear market. And in the process, what's going to happen is the central banks are going to print a lot of money. U.S. interest rates, I think, go down to zero. And so I still like the 10-year note futures. If you trade futures, those are obviously advanced. Another way to participate is the IEF. We talked about the 10-year, 7 to 10-year Treasury ETF. It's a little bit overbought at this point, but I think this continues to trend higher as interest rates in the U.S. go to zero or possibly negative, as they are in Europe and Japan. And what happens when you can no longer cut interest rates below zero? What you start doing is you start printing money, and this is already happening in Hong Kong. It's really unbelievable to see. Hong Kong government has basically printed new money and just given it away to every adult in Hong Kong. 10,000 Hong Kong dollars, which is, I believe, a couple thousand, around $1,300 US. But this is basically free money, trying to stimulate the economy. The Fed is going to be really ramping up their money printing as well. So I would expect, in addition to U.S. Treasuries benefiting in the short run, I'm still very bullish on gold over the coming months, and And then the last one that I really like, just because of all this money printing, as well as what's about to happen in May, is Bitcoin. Bitcoin is sold off a little bit from the highs, but it's holding really well here. And almost by definition, if you print a lot of U.S. dollars, Bitcoin, which is predominantly denominated in dollars, will rise as the U.S. currency is debased. So I'm staying away from momentum stocks for the time being. I'm long IEF, long GLD, which is the gold ETF. There are also a couple gold miners. Maybe stick to the big ones like Newmont. They're doing very well. I also like Kirkland Lake, though it's been really underperforming. So I'm going to be really sticking with Newmont. And then Bitcoin as well. Bitcoin is beginning to function as a new form of money, as a store of value. And the supply of Bitcoin is going to be severely curtailed in this May of 2020 just because of the code, the Bitcoin code. We have what's called the halving, which is going to become more and more talked about in the media. And I think that's also going to contribute a very nice tailwind to Bitcoin. So we're in a really interesting situation here where we have the printing press really ramping up, and at the same time, U.S. economy probably going into recession, and Bitcoin going through the supply contraction as the reward for Bitcoin miners gets cut in half sometime in May, probably early May it looks like. And so I think this is a very nice place to hide. Again, it's risky, it's volatile as well, but I'm expecting Bitcoin to be trading above 100,000 before the end of next year. Curious what you guys think of this market and how you're trading it. So if you haven't already, hit that subscribe button, hit that like button if you found this video helpful, and leave me a comment in the comment section below. Stay safe out there. Stay out of these markets unless you're a very advanced trader, and just take care of yourselves, wash your hands frequently, and I'll see you in the next video.